Hello and welcome. I'm your host, Gregory Saxton. Now I'm a full professor of accounting at Schulich School of Business and a member of Schulich Centre in Digital Financial Information, which is generously supported by CPA Ontario. We're excited to bring you another webinar today, and this one's by Dr. Colleen Boland on the audit expectation gap in technology. She's going to be bringing us some good insights from the US context, and thank you for joining us today, and welcome, Colleen.
Thank you very much. I'm delighted to be here. I'm going to do that awkward thing and bring up my presentation, and we'll go ahead and get started here, I guess. Like Greg said, I am a part of the faculty in accounting at the University of Wisconsin-Milwaukee. I have recently completed in 2021 an economic fellowship with the Public Company Accounting Oversight Board, that being the PCAOB, which is the audit regulator in the United States. And I'm sharing with you some of my research into technology and mapping it into the audit expectation gap, which is kind of a proxy, if you will, for how we think about audit quality. So, okay. Okay, here we go. Greg, I'm sorry, I'm not seeing the forward here.
Can you just do an arrow key or?
Oh, is that what it is?
Yeah, that should work, yeah.
Oh, okay, yeah, here we go. So I just want to start with laying out what I'll talk about in the order so you have some expectations as to the how we'll progress. So the first thing I'm going to address is why we audit, and then get into how that layers into the audit expectation gap, which, as I just suggested, is something similar to how we think about audit quality. Then we'll get into the promise of technology, because I'm trying to marry these two together. And so what's the promise of the technology, as well as then how does it layer into the audit? We'll move on more specifically. I do have a paper out with my co-authors, Nick Galanick of the PCAOB and Matt Sherwood from the University of Massachusetts Amherst. And we do have a paper that I'm drawing from in order to produce this presentation. It's basically looking at the tools, the technology tools in the largest 8 firms in the United States toolbox. So some insight there. And then we'll get into some implications as to how these come together. So the first thing, and I appreciate your patience, is because I was an economic fellow at the PCAOB, I am required to read this disclaimer anytime I present anything that I studied there. And so bear with me. The PCAOB, as a matter of policy, disclaims responsibility for any private publication or statement by any of its academic research fellows and employees. The views expressed in this paper are the views of the authors and do not necessarily reflect the views of the board, individual board members, or the staff of the PCAOB. So thank you for your patience on that, and we'll go ahead and get into the rest of the presentation. So, oops, I'm on the wrong screen here. So why audit? And that's, I just want to get us all on the same platform, the same basis. So we audit an audit is an independent examination of, in this case, financial statements, the financial position of a company. We do it for several reasons. One is to ensure compliance, the compliance with accounting standards and with laws and regulations. It provides accountability to the audit or to the management of the company. They're accountable to the various stakeholders through it. And because it's an independent examination, it provides credibility to management. You can trust management to do the right thing. In a nutshell, and because I'm an academic, what we say in the academic world is we audit to solve the principal agent problem. So let's take a pause here and just make sure we understand what that is. And the principal agent problem, the principal in most cases when we talk about auditing is the investor, the owner. It gets expanded more recently into creditors, or not just recently on creditors, but there's creditors that are concerned with how the company is being operated. There's labor, employees, taxing, and regulatory authorities are all concerned with how management runs the company. The principal is the owner, and the agent, therefore, is management. So there's 2 ways we have concerns because of separation between management and owners. We're concerned that the management will do everything they can in the best interest of the owners. And there's 2 ways that we can address that problem. One is we can provide incentives for management to behave properly and have our best interests at mind, in mind, at the front of the mind. And so we have incentives. And so those incentives to align our goals might be compensation, for example, stock options. Alternatively, we can monitor. And in monitoring, that's what an audit is. And so and back in the day, more than 100 years ago, what used to happen is the various stakeholders could come in and take a look. So the creditors would come in and look at the books and see if they were properly accounting for information, as well as the investors. That became very burdensome operationally for management. And where we evolved to was that management would hire someone to come in and provide a report on the trustworthiness or credibility of management's reporting. It's evolved where who hires the independent examiner, the auditor, is much more with the investors. But at the bottom, at the core, these are general purpose financial statements that various stakeholders do their box scores, if you will, to provide their metrics as to how they evaluate how the company is operating. So they issue a report, an auditor issues a report on the agent, and this is the opinion, the audit opinion. And as you see here, this is kind of taking the key points out of a standard audit opinion. Says right up front, the auditor it's their opinion. They're giving an opinion on financial statements. They're not saying it's absolutely correct, but it is materially correct as of this date and time. And it reflects the compliance, that the report is in compliance with international reporting standards of the IASB in Canada, and in the United States, it's the Financial Accounting Standards Board. So let's think about the challenges now to an audit, to evaluating an audit. The auditor is present to evaluate management's behavior, but now we go another layer, and how do we know as investors we're getting a quality audit? We've moved it from management hiring, at least in the United States, from management hiring the auditors to the investors hiring the auditors through their board of directors, their representatives. But there's still some challenges now as to how do we know that they're not shirking, that the auditors aren't doing an adequate job. And there's definitely some challenges. The first challenge is that an audit is in effect a credence good. And what a credence good means is that the user or consumer cannot evaluate the quality of what they receive. They can, not just the user, but the purchaser. And in this case, the board can't evaluate the audit, nor actually can management evaluate the quality of the audit. One of the reasons for this is there's limited visibility into the quality. We generally rely on outcomes from an audit. So we're in that period again of several scandals of there's failed audits, failed accounting reporting, and so we're restricted to the outcomes. And short of regulators going in and looking at the audit work papers through inspection, the process is hidden. So understanding the challenges of being able to evaluate that way. In addition, an audit requires significant judgment by the auditor. And making judgment in real time provides some challenges as to, is it a good judgment? And finally, layering on is materiality. Is the auditor aware of what investors and other stakeholders consider material? And it's such a fluid definition, materiality. At least in the United States, we actually don't have a definition. It's something that they're considering at the regulatory level, but to date, no one has defined it exactly to measure against. So moving on then, and there's what we call an audit expectation gap. It was first coined in 1974 in the wake of several accounting scandals, auditing scandals, and failures in the United States. And it was Carl Liggio, I believe is his name, and he was general counsel for Arthur Young, one of the largest accounting firms at the time. And he said, we don't have necessarily a problem with audit quality. We have a gap between what stakeholders expect. And he defined it as the difference, the audit expectation gap is the difference between what the public thinks auditors do and what auditors are supposed to do. And so those standards that we are supposed to live by, not just that we should live by as auditors. The audit has evolved. Governance has evolved. Standards have evolved. And therefore, the gap becomes dynamic. So even though you would think that in 50 odd years, 60 years maybe, 50 years, since he identified the audit expectation gap, shouldn't we have been able to cure it? But just think how many accounting standards and auditing standards have been issued in that time. In the United States, we changed our accounting standard setter and our auditing standard setter. So it was prior to 74, it was a subcommittee of the AICPA. Today, it's the Financial Accounting Standards Board in the United States. Before 2002, auditing standards were set by the committee of the AICPA. Today, they're set by PCAOB. So you would think that we would have resolved that, but it's dynamic. And as it changes, expectations change. In 2019, the ACCA, the Association of Certified Chartered Accountants, issued a survey of their 11,000 members and across 11 countries, including Canada. And they revised their definition of the audit expectation gap. They put it into 3 buckets. The first is the knowledge gap. That's what the public thinks auditors do and what they actually do. And so the knowledge gap is, it could perhaps be the public not understanding what a standard says. So for example, one of the issues could be the auditing firms provide advisory services to clients. Those clients, however, are limited and they can't be audit clients. But not all of the public understands that. And so there might be that knowledge gap. That's also an area in which auditors have historically tried to resist that they were doing anything wrong. And it's just people don't understand. And if they only understood, they would appreciate what we do. So there is that gap, and a lot of effort goes into educating the public. The next gap is a performance gap, and that's the difference between what the audit standards require and what auditors actually do. And it can go either way. Auditors can over-audit, if you will, do well beyond what the standards require. Alternatively, they could shirk. And we see the results of that shirking, that failure to do what they're supposed to do in inspection reports. And then finally, there's the evolution gap. And what are auditors supposed to do? And what does the public want them to do? And our best example of that would be probably, at least in the United States, ESG reporting, environmental sustainability, and governance reporting. At this point in the United States, there are no requirements for assurance on those measures. Companies are free to submit them or report them, but there's no assurance measures. Our SEC and PCAOB and the Financial Accounting Standards Board are all considering what a standard might look like if we were going to address that. An evolution gap can be addressed in 3 ways. They can, the standard setters can say, nope, we're good, we don't need to do anything more. And maybe then a different function might arise in the marketplace to address that. And in fact, a lot of the large firms are providing a separate advisory service to do that, but not as part of the financial audit. Alternatively, they can adopt some sort of a standard and put it out there. Auditors are now supposed to comply with it, but we may now have a knowledge gap in that the public doesn't necessarily understand what the new standards require. And so it kind of evolves, it kind of spirals. So now that we've addressed the audit, let's look at technology and the promises of technology before we apply it to the audit itself, and what I saw with my colleagues at the large accounting firms. So the first promise of technology is speed. This is how fast things get done, the throughput. We tend to see this is the automation stage. Things are just moving a lot faster. The next we see is scale, a promise. This is when I think about it, I like to think about scale is where you pilot something and then it moves across the organization. So if I can scale up a robotic process automation as I look at my accounts payable activity, I can scale it to accounts receivable. So it goes to scale. The next area is spread, and particularly for multinational organizations, companies, or even across large geographies that we all live in North America. The spread allows us to overcome geography and language. So the technology allows us to input in one place and it comes out in what we need in a different place. There's the smarts, and the smarts is where technology, and I kind of think of this like artificial intelligence or machine learning. The technology can train itself with human intervention, so the learning happens in the technology, but the technology and the logarithms can take care of many functions. And then finally, technology takes time out of the equation, which gets us back into speed. The biggest example, or the most prominent example I can give you, is email. So we need to make a decision. We can't, because of various time zones in a global environment, we can't all meet at one time. And so email allows us to continue that conversation and shrink the day, if you will. I know as a researcher, I'm always happy to work with colleagues in Europe, at least. That's where more of my colleagues are, is in Europe, because I can pick up at the end, in the middle of the day, what they did in the morning and in the middle of my night, and reverse. And so keeping things at speed and that asynchrony. So let's move now into technology specific into the audit. Let's pull these two together. So technology with the audit, the first thing, and there's kind of a hierarchy of technology adoption. We start with standardization. And standardization is where we make sure that our procedures all are the same. So if I'm an audit firm, I want cash to almost always be audited the same. There's some idiosyncrasies, but the process should be the same. And then I also want to make sure that all my data is standardized. If I'm pulling from different data sets, I want to make sure that that my numbers in accounting are in numeric format and not in text format. It might be valuable to have dates. We want to make sure that the dates are all in the same format. I don't want to combine from one data set where it's month, day, year with another data set where it's day, month, year. That creates problems. Once we achieve standardization and automation, we're more likely to have substitution, which is also the old economic labor versus capital. And so the technology in the audit, we see a lot of substitution and through automation and standardization. The other thing that we see happening with the audit and technology is it augments decision making. The first step we are seeing is those smart work papers, so templates and checklists. It guides and aids, particularly younger staff, in making sure they're not missing anything, they have completeness, as well as it points them in the direction this is the conclusion they should come to. I argue that technology through standardization and automation absolutely improves quality. The quality of the data allows for better quality decision making. There might be a counterintuitive in that we might miss making a good decision, but the data is there in a better format because it removes those outliers that are anomalies. And so technology improves quality. Whether we can measure it or not is a different issue. And then finally, it allows for innovation. Whenever I'm standardizing a process, I have the opportunity to reevaluate what the process should be, what it is. And innovation can come into being. Some of those innovations is adopting technology. Alternatively, consistent, there's also the opportunity to provide insights, new insights, because we have all this digitized data. It allows us to look at things that were, if you will, cost prohibitive because it was so challenging in order to get some insights on how the business is operating. So now let's dig a little deeper into what we do in an audit before we get into what these large firms are doing and the implications. So an audit tends to be a linear process. We start with planning, and in planning, we auditors start in planning, and in planning we look at risk assessment generally. Planning is where the auditor identifies where the risks are and where then they should be spending their time and efforts. The next area is to evaluate evidence. When the auditor puts out an audit opinion, the opinion on the agent, they look at evidence to support what management has asserted. These are the proper values in the proper accounts in the proper time period. And so evaluating evidence. And in evaluating evidence, the audit, when in our paper, in our research, we defined evaluating audit evidence as both the interim procedures as well as in the final fieldwork procedures. And then finally, completion. Completion is where we make sure those I's are dotted and those T's are crossed, and that when it gets issued, all of our stakeholders can rely on the report that's issued. When we looked at these big audit firms, and the firms that we looked at are what we call the big four, so it's KPMG, Deloitte, EY, and PwC. And then we looked at what we call the next four, so BDO, Grant Thornton, Crowe, and RSM. And what we found is that most of the efforts that they used technology for was the planning and evaluating areas. And what we found is that the big four just to pause a moment, we found that the big four have probably twice as many tools in their toolbox as the next four. And so I'm presenting this proportionally. So over 70% of the tools in the toolbox for the big four are used to evaluate evidence. Just over 20% are used in the planning phase. Now, right there, we're almost over 100%. And that's because one of the things we observed is that technology is starting to blur the borders between the linear process that we had, how auditors audited. So in the planning phase, and we're finding the next four is using a proportionally greater number of tools, but we think that they're using the same tools in planning and evaluating, where the big four are using different tools and a broader array of tools in the evaluation phase. So when auditors start the planning, they're doing risk assessment. We've also found that there's a hierarchy, as I suggested, of technology. So it's the standardization and automation, standardization first, automation. In the risk assessment, we see something similar in the planning phase. They adopt risk assessment tools, and so they'll do benchmarking, those kinds of things. And then they're a little shy in saying, well, I predicted it and I found it. Well, that's evidence. And so they're a little shy about that. So we see the big four, as they're starting to express, have greater confidence in using these analytic tools and these tools in risk assessment also to apply as analytic tools in evaluating evidence. And so the next four don't seem to be quite that confident yet. And so again, we're seeing more tools in the planning phase. And in both cases, the completion isn't as widely used, the tools. When we think about evaluating evidence, which is supporting the audit opinion, we really have about 6 buckets that we can rely on. One is a physical examination. We can go out and we can see on the factory floor, does the machine exist? We can go see, does the division exist at that location? We can go to look at documentation. Documentation could be contracts, it could be shipping logs, it could be invoices, and we look at all of those, auditors look at all those things. Analytical procedures, which I'll unpack a little more in a little bit. We look at the relationships between different elements of the financial statements. Confirmation, we go to third parties such as banks or customers, and auditors ask, is this really managed? The company says, this is the balance, do you agree? We observe inventory, and the auditor will inquire of management and third parties like the lawyers to determine if everything makes sense and they can rely on those representations. So when I'm asking, how does technology influence audit preparation? This is the first step in the technology that we see auditors using. And so it's important to note that the company, the client company and management prepares evidence, and they prepare it and give it to the auditor, who may also prepare it further so it works in their tools, with their tools and their methods and performance procedures. So the first thing that we see happening, and again, it's that hierarchy of technology, is process standardization. So there's how do we get our bank statements, our bank information so that the reconciliation can take place. And so the management, the company has a standardized procedure where they most likely tap right into their account and download it into their ERP system, and they do a match, and it provides what's missing. That's a standardized process. And then we find that the automation happens, and that's automating those processes. So when we started that standardization of the of our data, we might have started manually, and now we're automating it. This is where we tend to see robotic process automation, macros, those kinds of things. Process standardization, we are seeing smart work papers, for example, or checklists. And then finally, extraction, transformation, and loading data. And that's a lot of times we're finding that the audit firms are able to tap right into the customer's ERP system and pull out the data, and then they need to transform it so that it works in their data analytics process or program. So now, how does it map to evidence? That's kind of the more interesting. We have that preparation. What we find is that documentation is pretty strong. We're finding those smart work papers that I've already alluded to. The artificial intelligence is still promising, but it's not fully there. Our data, we looked at the data that we collected was collected in March of 2020. So it was already collected right before the pandemic started. And it reflected the tools that were in place in the before March. So mostly the 2019 audit engagements. In addition, the audit firms provided a 5-year look ahead as to what they thought they would be adopting within the next 5 years. We see promise for artificial intelligence, and it may have accelerated due to the pandemic incentives, but we did not see a wide distribution, a wide usage of artificial intelligence. And we saw those on like reading contracts. What we saw much more is these analytical procedures. And like I suggested, the analytical procedures, we saw a great deal of them in the planning phase. We see more in the evaluation of evidence phase for the bigger firms. What we tended to see is a lot of benchmarking from third-party vendors. We saw predictive analytics, regression analyses, pretty not very sophisticated, but a start. The challenge with predictive analytics is the function of an audit is historical, not future. And so the predictive analytics are currently being used to predict what they think the historical balance should have been. And then finally, confirmations. We see quite a bit with confirmations. Confirmations used to be where the management gave to the auditor, and the auditor mailed to whoever they were confirming, the bank or the customers. What then happened is a third-party tech tool arrived, and they used the third party for to do this encrypted confirmations. And then what we're finding is that almost all of the firms, these large firms, have created their own software, their own tool to do these confirmations. So what we found is, and this is these 5 areas of how they're using it. What are they doing exactly? Not why are they doing it. And we found that the audit evidence and assessment is significantly performed using tools by the Big Four. We find less variation across the 5 buckets for the next 4. This again exceeds 100%. And so the audit firms are absolutely blurring some of these borders between what used to be discrete activities. So they might have a tool that performs extract, transformation, and loading data. And in doing that, they're standardizing processes and standardizing automation, and they're adopting automation. But more interesting is what the audit firms are using the technology for. And what we find, and again, this is reported by the large firms, what we find is the Big Four are blurring the borders between aiding in decision making, as well as visualizing, summarizing, tabulating, and modeling data. Those are used in similar veins, we find that the next four are using it much more for determining a sample size and the visualize and summarize than they are aiding in decision making. How much of that is reporting, and more sophisticated reporting is unclear, but we do see some differences there. So let's pull it all together. We've gone through our discussion on what an audit is, why we audit, and what the problem is we're trying to solve. We also identified how expectations of stakeholders impact the determination of audit quality. And so if we pull those together, how does technology decrease these expectation gaps? The first thing that I would suggest is it enhances quality control. And in quality control, it enhances internal to the audit firm that all the engagement personnel are complying both with firm standards as well as the auditing or accounting standards that are underway, that are in play. And one of the ways that they do it, and I think probably the most significant way they do it, is standardization. So all the processes are being standardized. We're observing a much stronger central office that's evaluating much stronger activities on internal control reviews. The IAASB issued their quality control standard in the last couple of years. The AICPA did the same, and the PCOB, leveraging off of the work of both of those organizations, put out their proposed draft last month. Technology plays a heavy role in that quality control, in those quality control standards. With technology, the audit firms have essentially three digital ecosystems, three platforms or portals in a digital ecosystem in which they evaluate the toolbox. And those are required, those platforms are required on every single engagement that we found when looking at these 8 firms. They're about the only things that are required. The first part of this ecosystem is what I would call a client portal. And the client portal is where the client provides either access or documentation to the audit firm. They download or they put it in electronically so that it can be accessed. The second place that we see, or the second portal, is internal, and that's where the work papers are housed and worked on. We also find in their internal, the firm's internal documentation and standards, their standardized work programs, those kinds of things. And then finally, the third portal, which may be combined with the second portal, is data analytics. And that's where they do more of that analytical review, that more robust presentation. We also find, as part of the quality control, that in our paper we looked at who gets to decide what tools are used on the engagement. We found that these portals are required on every engagement, but very few other specific tools are required. The firms are giving the auditors a toolbox of approved tools. They can't identify or use any tools outside of that toolbox until it's gone through a certification process internally. And that certification process happens on average between 1.5 and every 2 years. Other research suggests that because of this quality control, these kinds of quality control mechanisms and the vetting of these tools, that it provides additional competitiveness for smaller firms against these larger firms. And I'm not sure where that comes down yet, but that is an opportunity for decreasing the gap, if you will, is that smaller firms can be more competitive on larger engagements because of technology. And that's where we're talking about scale and efficiencies. Because technology allows audit firms to scale up, it allows them to compete on sized clients that may not have been available before, as well as provide efficiencies and probably enhancing profitability of engagements. And then finally, we are an apprenticeship. The accounting profession is an apprenticeship model. Students graduate and they start very basic kinds of audit activities where they start to learn how to evaluate. They develop their professional judgment. They hone their professional skepticism. And the technology can aid them in that and allow them to come in at, I started in the 80s in my audit career, and that was we were just using a PC a little more than as a typewriter. But now the technologies are taking these junior staff and asking them to do things that would have been more common at the 4 or 5 year level back in the 80s, for example. And so it's an aid for younger staff. So if we think about expectations, the technology that's in our zeitgeist, in our everywhere, allows creates the expectation that we can perform better. I think that when we're talking about technology, the performance is really where we're seeing our best results, our best returns from technology is in that performance gap. I think that, and we'll talk in just a second, the implications for the knowledge and the evolution gap are probably not about decreasing the gap. So the challenges for increasing the gap is scope. We have an expectation, or our stakeholders may have an expectation for auditors that they, because it's done not manually, they can do more of it. And so why are we only sampling accounts receivable? Why aren't we doing the entire population? Because how hard could it possibly be? You run the same program on the same things. But what I found is that the scope, because we can do it, we have to be much more careful about what we identify as our populations. There might be a lot more heterogeneity in the client base, meaning the accounts receivables, than we may have expected when first contemplating and even doing our sampling. And so it might be increasing the gap, but as it gets better understood, it might actually enhance the gap. Further, there's because of technology being out in the wider world, I don't know how many of you have had the experience of having your credit card stolen and your bank calls you and tells you it's been stolen. The fact that Google can predict what you're going to do next and lead you to ads, those targeting ads, there's become an expectation, as the ACCA survey identified, of greater ability to detect fraud and errors than existed in the past, that ratcheting up of expectations. And yet the auditor is still charged with auditing the basic financial statement. And if you're a fraud auditor, you know where to look. If you're just out there doing everything, it becomes a lot more challenging. The technology is helping address this issue, but I think that the expectations are exceeding the ability of the technology in order to catch that. And then finally, because of all the areas that we see outside of the financial audit in prediction, there's an increasing expectation that the auditors can predict the future. And that's something that, is more challenging, and we're, at least in the United States, extremely reluctant to go beyond historic. And we even get a little twitchy when it's fair value, which is getting us much closer to that predictive. And so those predictive expectations, those expectations about the ability to predict, may be increasing the gap. And so that's one of the challenges. So I'd like to now kind of wrap this up and look at the implications. What does this mean? We've gone through why we audit, how audit expectations are formed, which have implications for the evaluating the quality of an audit, and how does technology layer in order to help the audit quality, if you will. There are opportunities for standard setting because it's still so fuzzy. The IAASB, the AICPA, and until recently, the PCOB all had evidence as part of their agendas, evaluating evidence in light of technology. Now, the PCOB has taken it off their agenda, but they've added it to the quality control standard, and they're still they just stood up a new technology advisory council, data analytics. So there's still quite a bit of unease with what does it really mean and how does it map. It's a little bit more defined than it was, I would say, even when I started my project in 2019, but it's still unsettling. And so the question becomes, do standard setters need to add new standards, or do their staff need to add more guidance, or are the standards just fine and it's just another tool in the toolbox? So just like we adopted PCs, we were using them in the 80s, it's just a tool. It's the PC. What is this? How is this different? Well, the one area it could potentially be different is it could potentially change the very nature of an audit. An audit is a historical document, or excuse me, the audit is an opinion talking about a historical document, meaning the financial statements. We have evolved, and is part of the plan, part of the interim field work, and I didn't address it because there's not a tremendous amount of tools. There is a significant effort, however, in evaluating the internal controls, the general controls over IT. And as we get more and more, as our clients, as the companies get more and more automated and digitized, there's increasing efforts to make the examine the process and certify the process as opposed to the outcomes. And the outcomes is the report that auditors now do is on the outcomes, not on the processes. There's potential for competitors in that ERP systems could do essentially an assurance report that their technology is working as it's supposed to, so you can rely on the output and do a big carve out of the financial statement audit. That's one potential that futurists are identifying. Another potential that we're seeing, at least in the United States, is we're revamping our certification exam for our public auditors and adding an emphasis, excuse me, on the nature of the IT and the processes involved with the IT processes in order to relate or to rely on the outcomes. That's a potential. We don't know where it's going to go. We think, at least in the United States, that that's less likely because we have the licensure. But that doesn't mean that it's not going to evolve, and the skills that are required of auditors aren't going to change to compete with these ERP systems, for example, to be much more focused on technology and less focused on accounting. It remains to be seen. And then finally, I'm calling it, quote, pre-staffing, because there's two pieces of staffing that are impacted. One is at the university level. And at the university level, are we preparing our students to meet the challenges in the workplace? Do they have the skills that they need? We've focused extremely hard on making sure they understand accounting standards and that they're conversant with the auditing standards, so they're prepared to learn on the job in the apprenticeship. Universities across the globe have adopted data analytics kinds of activities, whether it's standalone courses or increased integration within courses that already exist. And then it also has implications for staffing at the firm level. Because this apprenticeship model appears to be receding, not as effective or not as valuable, will it flip? I know my students frequently go into public accounting for that however long, up to 5 years, and then they jump and they go to companies, to the clients. They got the experience they needed in auditing, and then they go and they work in a single place. The potential of, because of moving away from an apprenticeship model, replacing that apprenticeship time with technology, we could have it flipped where the students will now be going into corporate or into companies and getting their years of experience and then going into auditing. And that remains to be seen. Additionally, how do we staff the audit? Because we have the substitutive effect, will we have fewer members of our engagement team? And our engagement teams get smaller. In addition, several of these tools require specialists. And if we are requiring specialists, we have more specialists now on the engagement team, but they're not part of the core. And so how will that play out? I'm going to give you a little tease. I'm working on that as the next project. I don't have it fully completed, and I'm not at liberty to share my results. But those are all interesting implications. And so with that, I'd like to thank you for your attention, and I'm very eager to hear any questions you may have.
Oh, hey, Colleen, thank you for that. So there is a question there you can see from Abel Lazarus. He asks, a lot of what is in the financial statements in the notes today include estimates and judgment. Has your research on technology implications touched on this?
Not directly, but it's in the area. What we're finding is those estimates are really looking, they're using those predictive analytics quite a bit to come up with those estimates, and the ability of the technology to benchmark has been extremely helpful. We find that audit firms, audit partners are struggling with junior staff, in that they don't necessarily have the requisite judgment to take the results of the technology. And so I would say that's a mixed bag. I'm not sure if does that answer your question, I hope? Let's see. I see Tamina has asked about sharing the slides. I don't have a problem, Greg, if you make that available.
There's also some questions people are asking just in the public chat there.
Okay. Do you have a guide for me here?
Okay, sorry. And Tamina, could you just put the questions into the hosts area? So Ali asked a question: is the technology helping more efficient audit, or is that taking away from the audit judgment?
It's both. We haven't done as deep a dive. We're just in the process of doing that deeper dive at the engagement level. Our research to this point is what's in the toolbox, and basically who gets to decide what tools to use. The tools to use are, what we found is there's only a requirement to use those basic compliance with firm standards. If they want to use Alteryx, if they want to use Excel, if they want to use some proprietary, and there's very specialized tools that they can use. The audit partners, audit engagement team gets to decide which ones they use. We do find, and it's been well documented, that concerns of the audit, the more senior personnel, it's definitely having struggles with judgment and skepticism. They're working to determine how to resolve that. You know, it's part of the evolution. But yes, it goes both ways. It exasperates and shrinks the technology or the expectation gap. There's quite a push on whether data analysts will be needed in an audit firm in the future. Those analytics, what we're seeing, what I'm hearing is that they're using it much more in their non-audit practice. We know that audit firms are well beyond just doing an audit, and I don't mean to diminish an audit. It's extremely important, but they might use them in mergers and acquisitions. They might use them in other consulting, and they're heavily investing in those data scientists in those areas. There's, at least in the United States, the regulations regarding licensure are non-trivial, and so they are hesitant to go beyond the supervision that the auditor can provide if they do have those data analysts in place. Should there be a standardization helping a level playing field for all companies? I'm not sure I understand what that question is. I think it's getting towards, should our audit standards be standardized? Right now, firms, at least in the United States, we were accused of being very rules-based, which would suggest a lot of standardization, and that we needed to be much more principles-based. So everyone can take it and make it their flavor, if you will. And we do, the research is pretty clear that audit firms have a style, if you will. The standardization happens, we're seeing it much more within the audit firms, where they're standardizing their processes. So they're within an audit firm, there's not as great a difference in how an activity is performed, an audit goal is performed, as we see between audit firms. And you see that actually in the footnotes. There's some pretty extensive research that's been done that the footnotes follow a style within a firm, and that there's not a standardization across firms. The information gets out, but not in the same way. Any audit experience to share in blockchain related industry, given that technologies are advanced so much? You know, it's interesting. I think it was just in the Wall Street Journal this week, in fact, that the promise of blockchain isn't really coming to fruition. There's a lot of promise, and you know, the promise back when it was first introduced is it would replace auditors. We don't need to have auditors, if we have this transparent ability, everybody can come in and, if you will, go back to the future, kick the tires. Every stakeholder can look at, if they're given permission, can look at everything and not disrupt operations. But they're finding it to be a much bigger lift than anyone expected. Used for fraud detection. A lot of that is the fraud detection tends to look at anomalies. And so one of the things that's come out in the last several years is visualization. Most of us, I think the number in brain science says 60% of us are visual learners. Only 10% of us are auditory learners. And so that visualization allows those anomalies to pick up, to be captured. Let me see. The audit company absolutely can use these technologies. The issue as to why it might be challenging is scope. How do they define where to look? And if I am a forensic auditor, I know that there is a specific area that I think is funny, and I look in a very small area. It's kind of like there's a story about a person, they lost their keys, and it's at night, and someone comes up and asks to help them. How can I help them? And they said, sure, you can help me. And they said, well, where did you drop them? And they said, well, over here. And he says, well, why are you looking over here? I'm looking there because that's where the light is. I can see over here, even though there's no, I didn't see it, or it shouldn't actually be there. I only look where there's light. The auditors, or the forensic auditors, know exactly what's bound to look if there's a problem. A general purpose auditor has well beyond that scope. And so they have to go a little bit more. Is there a likelihood in that area that I should look deeper? And they have to be very careful about it, but they may have missed a signal that would suggest there's and the level of fraud isn't known. So we don't even know if it's material, but we could miss the fraud because it's not material. And yet expectations are increasing that fraud in and of itself, that materiality may not matter. That might be a public expectation. Let's see. So specific technologies, I would suggest the specific technologies are anything that allows the data to be digitized, and then it's as creative as the data scientist can get for the technology. You can look for fraud using Excel. You can look for fraud using Tableau with visualizations. There's the red flags that you can look for fraud looking at ratio analysis, which doesn't require a lot of technology. When we're talking about the technology and the expectations, I think it's much more that they're expecting everyone, the auditor, to go through multiple transactions, 100% of the transactions. And if that's the case, that it will raise its hand and say, hey, I'm the fraud, I'm over here. Do more digitized audits raise a different profile of issues from audits, such as the items in the management letter? I can only think about that. I haven't observed that. But we also have in that management letter, in that ecosphere, I guess I might say, the critical audit matters that have been adopted throughout the world. And I think the digitized audits, I don't know what it does for the profile, but I think that the requirements have become sharing much more of how the auditor views the audit, might give rise to some of the digitization. I think that the digitization has allowed the audits to be more carefully performed than back in the day. I absolutely think that technology has improved the audits. It also may have improved identifying where audits have failed. I'm not positive that answers the question. So please ask me again if it does not. So the question is, I'm wondering what you saw in terms of technology tools related to enhancing the professional skepticism in auditors, especially more junior auditors. This is an area that the firms, I think, are putting a lot of effort in their reporting that these are aid in decision making. We still hear concerns about professional skepticism, but I'm not sure that those concerns are ever going to go away regardless of how well we do. Junior auditors need to get mature. They need experience in order to understand. And that's one reason that I suggested that we might see the model flipping, where the junior auditors are coming in from corporate. And actually, that's how the inspectors are hired. They're coming from either corporate or from prior auditing in order to be inspectors. And so this professional skepticism, it needs some maturation. They're putting in as many tools as they can. There are studies that say that the junior auditors benefit, or not junior auditors, junior whatever profession benefits more than senior whatever profession from using these assists, these technology assists. These are great questions. I really appreciate everybody's input. I don't know if there's any other questions that I might answer. I know I've really appreciated the opportunity to share my research and share my observations.
Okay, yeah, those are great questions, and thank you very much for the answers, Colleen. And I'm sure they all got a lot out of it. I think if you want, there's one more about the digitization risks that audit firms are facing and how you might mitigate it. If you have a quick answer to that,
Oh yeah, I'm just saying it. I think that if I were thinking about the risk, I would think that it's a risk of expectations. And the expectations are rising. The more technology we have, the more that I think the public expects we can do. And I'm not sure that the public is as aware as we might think, because it seems so magical, so ability to look in that crystal ball and know what's coming. And so I think that raises the expectations. And I think that the risks are that it's very difficult for the audit profession to keep up to those rising expectations. And they also then run the risk of appearing defensive if they don't. So anyway, that would be the insights I have. I don't have anything I can point to, just my sense.
No, that's great. Thank you. And I learned a lot today. So I thank you for joining us, and thank you, Colleen, for sharing your insights. I'm pasting into the chat here just some upcoming webinars. We don't have the registration up for them yet, but from January till May, we have a half dozen or so. So we will be sending out automatically an email again with just that will serve as proof of attendance for professional development hours. And that's it. I hope you have a wonderful rest of the Friday and weekend. And thanks again, Colleen. And I hope you all have a wonderful weekend and a great holiday season. And we'll hope to see you back here in a month. So thank you and have a good day.
Thank you, and happy holidays.
Thanks, you too.